So now, having estimated our level better, we can now move on to the WACC calculations. So for the target capital structure, we're going to be bringing in the proportion of debt to equity for Amazon. As we said a while ago, that the proportion of debt to equity must be based on the optimal capital structure. So a company taking a lot of debt must be doing that based on the total debt to total capital based on that company's capital structure. So it is an incentive. There is an incentive for companies to take debt because of that tax shield or the tax savings that comes as a result of interest, which is tax deductible. However, that interest, which is tax deductible, must be offset by any future bankruptcy cost. So, for example, we have the direct and the indirect bankruptcy cost, which takes into account the government taxes. So, if the pre-tax cost of debt is not offset by the tax, says that should be paid if this company goes bankrupt, then that capital structure or that company might be nearing bankruptcy if the effect of debt financing, that is to say that the tax shield or the tax savings is less than the bankruptcy cost. Or the bankruptcy cost, in this case, the direct bankruptcy cost, which is the government taxes, is greater than the interest tax savings. So essentially, that's what we are seeing here. So why it could be very beneficial for companies to issue bonds at the same time, issuing bonds could lead the company to file for bankruptcy if the tax benefit is less than the bankruptcy or the future bankruptcy cost. So that is why the target capital structure is very important. And there we're going to be bringing in that target capital structure and estimating that in relation to whatever we have here from our comparable company analysis. For example, we have here between 9.3% and 7.9%. So that capital structure should be within that range based on our comparable company leverage multiple. So we have to be within that range. So that's how we're gonna be determining that. And also we will just bring in the current capital structure from Amazon here for reference, which we already have in our comms tab. Then we have the cost of debt, which we will have to use that to determine our weighted average cost of capital. So we have to weigh the after-tax cost of debt to the proportion of debt. And of course, it takes into account the interest expense, which is tax deductible. So we have to account for the cost of debt, which is that pre-tax cost of debt, which is tax deductible, to arrive at the after-tax cost of debt in order to weigh that to determine the weighted average cost of debt. And then we will add that to the weighted average cost of equity. So the weighted average cost of equity is divided into the cost of equity and the proportion of equity. So for the proportion of equity, we already have that set up here. We're going to be bringing up that here in a bit. And then for the cost of equity, as we said before, we have here the risk-free rate, which is essentially the rate of returns in investing in a risk-free security such as a treasury bill. And also we have the equity risk premium, which is the additional risk taken in investing in a stock above the risk-free rate, or any rate of returns on an investment that is more riskier than a treasury bond or a treasury bill as an estimate, or a government bond as our risk-free rate. So essentially, that's what we are saying here. So we're going to be bringing that here because the cost of equity, it's determined using the capital asset pricing model, or we can call it the security market line, where we take into account the beta of the stock, and we also take into account the equity risk premium, we take into account the risk-free rate, and then we can also add other risks such as the country risks, the size premium, the company-specific risk premium, and the levered company-specific risk premium as such. So we have all of those in place in determining the cost of equity. So the cost of equity, essentially we take the risk-free rate, and then we add to that the levered equity beta, multiplying the levered equity beta by the equity risk premium, and then we add other risks that might be exposed to that stock, such as we have the country risk premium, size premium, company specific risk premium, which is the unsystematic risk as such. So that's what we're going to be doing here in determining the cost of equity. So as we said, it's very, very important for us to understand this concept, as this it's really applicable for private companies and also for publicly traded companies if the data is not available. So it's very important for us to understand these calculations here. So having done the cost of equity, we will later on weigh that to the proportion